limited room for RBI availability, there are significant uncertainties getting built up, specifically after announcements of tariffs. You might see some impact on currency. That over the last 4 months, RBI has done a significant front loading of all the monetary policy actions.
And in this scenario, how should the investors invest?
The US economy started to show some weakness. Another important variable is that we have started seeing some weakening of employment data. So both growth and employment are showing some sign of weakness.
Hi, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me Devang Shah, Head Fixed Income. Today we have Devang talking to us about the developments in fixed income markets in terms of the monetary policy, in terms of where the markets are headed, what should investors look at, and we also have a special topic about is the rally over in long duration bonds. So Devang, starting with the policy outlook as such, what do you think? The central bank kept the interest rate steady. Do you think you were expecting this? What was the market expecting?
Right. Thanks, Shalini. So yes, I think there was a divided camp. This policy, everyone, because of the significant fall in CPI, plus we have started seeing some bit of trend on high frequency indicators weakening. People said that this is a good opportunity for RBI to start looking at further rate cuts. So there was a divided camp. A part of the camp was believing that RBI would probably even pause. Part of the market was believing that somewhere down the line there will be a 25 basis cut. RBI's monetary policy action, if I summarize, they've kept all the rates status quo, unchanged. It was a consensus view, and there is no significant any changes in stance. From a perspective on operative rate, they continue to hold at 5.5 on repo rate and the SDF at 5.25. Our view is, in fact, that we were more in the camp that RBI should not do anything, and there are specific reasons why we believe RBI has done a good job of a wait and watch approach at this point of time. Specifically, to start with, yes, near-term inflation is all good, and you will see this month's inflation probably below 2% on the headline. But as RBI's monetary policy should be forward-looking, RBI understands that Q1 next year, inflation will be above 4.5. Their projection is 4.9. Our projection, internal projection, shows that 4.5 is the CPI number for Q1 next year. Also for FY27, the inflation is above 4%. If that is the case, the overall opportunity for RBI incrementally, any which ways to cut rates is very, very limited. The second important thing is that, yes, there are some visibility or some factors on the macroeconomic indicators which have shown some muted trends. But are we seeing a crack in the economy? My view is no. If that is the case, limited room for RBI availability, there are significant uncertainties getting built up, specifically after announcements of tariffs. You might see some impact on currency. We need to see how oil and if there are additional tariffs on what we import from Russia, there might be some volatility on oil prices also. All this creates vulnerabilities and uncertainties in the mind of central banker. So my understanding is definitely a wait and watch. And yes, RBI has done a good thing by keeping a pause in this policy. Let's also understand one thing, that over the last 4 months, RBI has done a significant front loading of all the monetary policy actions. They did 100 basis of rate cuts. I've always told it's not 100 basis, it's actually 150 basis because they've moved from a significantly tight liquidity environment to a very easy liquidity environment. So there has been a huge influx of liquidity. Operative rate has changed by 120, more than 150 odd basis. And secondly, they've delivered 4 rate cuts. They would want to see the impact of all this. Transmission of monetary policy works with a lag, and hence I think a pause significantly makes sense in this policy.
Okay. What is the outlook for the markets, for the fixed income markets in India and the US? And in this scenario, how should the investors invest?
So if you ask me, I think first all of us need to understand that 2024 was a year for rate cuts and massive duration rally. From here on, yes, if there is a growth crack and there is visible growth crack in India and globally, we might see RBI continuing with a couple of rate cuts. So there might be a 25 basis rate cut or at max 50 basis rate cut. My personal view is that I think large part of the rate cycle is over. We are at the fag end of the rate cut cycle and we will not see incremental rate cuts from here on. But if there is a visible growth shock, we can see a 25 basis rate cuts. The important point to understand is that at the fag end of the rate cut cycle, duration doesn't work so much. So now at this environment where market liquidity is significantly positive, I think investors should also change gears and should start looking at the short end of the curve. The 3 to 5 year segment, we have been now talking about this for last 3-4 months since April, May, that the risk reward for investor incrementally in the short end of the curve versus the long bonds is similar, and hence we continue to advise clients that at the fag end of the cycle with limited rate cut opportunities, I think investors should now focus on the short end of the curve. Okay. You also asked about the point of what's happening globally. Globally, things have started to, and specifically if I cover US markets, the US economy started to show some weakness. Another important variable is that we have started seeing some weakening of employment data. So both growth and employment are showing some sign of weakness. Will Fed start cutting rates? Yes. But will it be a very, very aggressive rate cut cycle? No. We continue to hold our view that Fed will continue to probably do a couple of rate cuts from here in this calendar year. So our view is 2 rate cuts in calendar year 25, and we'll probably see a couple of rate cuts next year. But central bankers globally, like last year they did massive easing, I think this year they will be confused and worried between stickiness of inflation and significant, I would say, some bit of slowdown. So with that context, monetary policy easing will continue, but it would be limited monetary policy easing globally. So that's the way which we hold for US markets and specifically Fed.
Okay. You've recently released a note, is the rally in long duration bonds over?
Right.
Can you elaborate, and what are the key takeaways for investors from this note?
So what we have written across in this note, and I just gave a synopsis. So there was a lot of context about that long bond spreads are trading currently at very, very high levels. Absolute yields are good. So what should investors do? See, first of all, when I look at investors and I talk about them, there are 2 sets of investors. One is the real money investors, which are like insurance funds, provident funds, and pension funds. At an absolute yield of 7.10, where your inflation in India is at around sub 4, even next year inflation at 4%, are these assets good to hold? Absolutely, these assets are good to hold. But when you're talking about mutual fund investors, specifically investors who are investing in debt mutual funds, I think we need to understand that long bonds, as I've been explaining before, they work well and they give capital appreciation when you're looking at the beginning of the rate cut cycle. We are now at the fag end of the rate cut cycle. As I've highlighted, I think our view is large part of the rate cycle is over. In fact, we don't expect significant rate cuts from here on. Even if there is a crack in the economy, we'll hardly see one more rate cut. In that context, investors from a mutual fund perspective and for who are investing in debt mutual funds, I think should start looking at shifting gears. What are the other important messages which we have covered in that long bonds? And just to explain you some bit more of it. See, the long bonds work on 2 or 3 perspectives. One is the macroeconomic variable. Like last year, why did they give a massive rally of 70-80 basis? Is because of weakening macros. You saw rate cuts, you actually saw weakening growth, fall in inflation. So that was one big reason. The second fundamental reason why bond markets rallied in India, and specifically long bonds did well, because there was a huge fiscal consolidation in India. We moved from 9% to 4.4%. We have halved on fiscal consolidation. Plus, tactically, last year, it was a very big year for positive demand supply dynamics because we got FPI flows because of JP Morgan inclusion. We got also open market operations from RBI to the tune of more than 5 lakh crores. So all of this actually added to the positive rally in bond markets. All of these catalysts which were working last year are no longer, I think, positive. Your demand supply dynamics is worsening. We are at the fag end of the rate cycle and there are no more OMOs left in this year. So my understanding is that at this point of time, I think investors should start looking at shifting gears and should probably look at the short end of the curve. The long bonds, which significantly rallied last year, a large part of the rally is over, and incrementally from here on, investors should focus on the short end of the curve.
Thank you, Devang. That was so insightful. Thank you for your time today. Thank you to all our investors for tuning in to Moneynomics. Please stay tuned for more such insights. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.